Welcome back. Wrapping up last week, we had the unemployment report, non-farm payroll report, which was released, showing 339,000 jobs were released versus the expectation of 190,000. The unemployment rate went up to 3.7 versus 3.5. Now, the overall non-farm payroll was good, but we're going to see in a moment most of the number actually look pretty good. Labor participation rate was flat at 62.6. Average hourly earnings 4.3 versus 4.4, very close. Private payrolls were up 283 versus 165. The manufacturing payrolls are down 2,000 versus a positive 6,000 expectation. So the real strength here were the private payrolls. Here we see S&P 500 in blue versus the unemployment rate. Now, this is curious because the non-farm payroll was good, but the unemployment rate still went up. And we could dive into the math, how they calculate these figures. We will see divergence from time to time, but nevertheless, I think it's important to note the 3.7% unemployment rate is the highest level we've seen for this unemployment level going back to October of last year. It's not a huge breakout, but it's not really a great trend either. Seems to be ticking higher. This is the labor force participation rate in black versus the S&P 500. There's a pretty strong positive correlation. As stocks go up, so does the labor force participation rate. This is the overall non-farm payroll. The black is the reported number that we always talk about. The yellow are non-farm payroll services. Green are goods. Red is government at the bottom. And the dotted red line is non-farm payroll private. We can see that the close correlation exists is the non-farm payroll private and services, which makes sense. It's a service-driven economy. These are ticking higher. The trend is your friend, and the trend does look good for the non-farm payroll numbers. This is average hourly earnings versus the S&P 500, which over time continues to chug up, as does the stock market. The unemployment rate ticks higher. Again, this is a little bit, doesn't really make a lot of sense, but 3.7 nevertheless, it is ticking higher while the S&P 500 seems to find strength. Now, stock market's going up for its own reasons, the expectation of higher interest rates, perhaps the expectation that, or higher, I should say, the expectation of higher corporate earnings and the expectation that maybe interest rates are close to their tops. Current labor force participation rate is flat for 3 months now versus the S&P 500, which is ticking higher. So we'd expect either stocks to start to lag here or the labor force participation rate will continue to tick higher. This is the average unemployment rate by state. If you take all the states and calculate their average unemployment, that continues to go down. And that does make sense. We spoke about last week the state unemployment levels, which have a very strong correlation to stocks. Now, speaking of the stock market, we have 4 major indices that we follow: the Dow, S&P 500, NASDAQ, and Russell. You can pause the video here if you want to read the details. Basically, the Dow are the 30 largest stocks that we know: Coca-Cola, Home Depot, etc. S&P 500 are the 500 largest listed companies. That's the broadest measure of the market, the overall market that we know. The NASDAQ is heavily weighted towards technology, biotech. Russell 2000 are the small cap stocks. Now, this is what present day the different stock market indices look like. Now, the way we measure them, take a look at the left-hand axis at the top. We have 0 all the way down to 400. These are the rankings. If you take all the stocks and we want to compare them on an equal level, we rank them all over the past year. Where does today's close rank in terms of the overall market over the past year? This way we can measure them or compare them all on an equal basis. If for example, the NASDAQ, the green line, is at its 52-week highs, we'll see the ranking it's at 4 right now. So it's the 4th place, meaning it's almost at the very top of its yearly rank so far. The purple line is the S&P 500. Notice the divergence, though. The red line is the Dow Jones Industrial Average. That has a ranking of 110, which means it's not at its 52-week highs. Take a look at the Russell, the yellow line. That's at a ranking of 162. very much off. It's still probably above its 50% level for the year, but it's important to note the differences because the stock market's comprised of many different stocks, many different companies, sectors, industries, etc. They don't always move together, and when they begin to separate, that's when we see there's a change. Now, the black histogram bars in the background show us the spread. The wider the divergences between these indices, the higher these histogram bars are. So, for example, the beginning of 2023, all these lines are really clustered very close together. From the highest indice to the lowest, we saw a very low spread. The spread is just the difference between the highest and lowest rankings. So down around the 50, 60, 70 level, right around here. But when the stock market started to go up, the red line, the purple, the green, meaning the Dow, S&P, NASDAQ, all went up. Russell 2000 didn't so much. The ranking, or I should say the spread increased. The spread increasing shows us it's the beginning of a change. It's not necessarily up or down, but it shows us something is different. We could actually, we could look at this many different levels. But just recognize that when the market's going up and we have a true, let's say, a true very strong economy, a very strong stock market, all stocks rise, like January, February of this year. But when we start to see a trouble in one sector or another, what happened within the past couple months? Well, the banking sector, specifically the small cap banking stocks, they started to waver. Silicon Valley Bank and, a lot of those others, they started to fall apart. Well, that's when the spread really jumped up. And that's why the Russell 2000, the yellow line, failed to go up and the spread increased. See, this shows us that while the big cap stocks are going up, small caps not so much. Now notice currently, where do we see the Dow Jones Industrial Average? That's Disney, Coca-Cola, Home Depot, Walmart, the very big companies out there. They're not faring as well as the overall S&P 500 and NASDAQ. Now, of course, there's only 30 stocks in the Dow. So one stock, such as Disney or something else going down, that can drag the whole index down a lot. But nevertheless, it is telling us something. Now, in the year 2000, we see July, August of 2000, all the indices were very close together. Of course, we know what happened late 2000, early 2001. Stock market started to fall apart. Look what happened first, though. Look what led the market down. And this really helps us define the theme of the market. And maybe if the market's going to turn down, if it's going to crash, what's going to lead it? Well, in 2000, it was the NASDAQ stocks, the tech stocks, the black line. That went down first, dragged everything else down. In the year 2008, it was a financial crisis. The Russell 2000 went down. That was the black line. Those are the small stocks, as well as the S&P 500. Notice the NASDAQ. Those are tech stocks. They didn't go down so fast. They eventually, of course, all stocks eventually did go down, but it wasn't a tech crash at that point. It was a mortgage crash. We know 2019, stocks were very strong. Look how tightly packed all these lines are together on 2019. What went down first? The Russell 2000, the small cap stocks. And that is a very popular phenomenon, that when markets go down, it's usually the small companies with the least amount of capitalization that are running on the thinnest margins. They have the least, sort of like insurance, so to speak, for bad times. They tend to suffer first. The Russell 2000 went down, so did the NASDAQ. The Dow Jones Industrial Average, of course, eventually did go down, but really didn't go down very quickly at first. In 2001, notice how the blue line's the Dow. Notice how the spread reacts. Now, we go back to 2000, stocks are chugging along, the spread's relatively low. The spread starts to widen, even though the Dow is kind of holding still. We go to 2001, and the Dow's literally at all-time highs, or very close to it, while the spread was very wide. This spread is a warning signal. Even though the Dow is very high, it's telling us there's a lot of other stocks out there that are not doing well. The spread increases, and that told us what was about to happen. And then, of course, 2002, we saw the spread spike up again as the Dow was about to go down. Same phenomenon took place in the year 2008. The spread was very, very low in '07. Stock market's chugging along, even though the Dow's really close to all-time highs. This is a warning signal. Now the spread is around 250 or so at this point. We go to 2019. Dow Jones Industrial Average chugging along August, September of 2018, still almost at all-time highs. The spread starts to widen, and then of course we know what happens 2018 and further on. Now, current spread, you may wonder, where are we now? The red line, I should say, is the Dow Jones Industrial Average. The Russell is the yellow line. We chose these two because they do have quite a large divergence. Now, the Dow, April, just last month, we had the Dow at a ranking of 16, while the Russell had a ranking of 246. The spread at that time was almost 250, around 230 or so. That's a very high spread considering stocks are very close to the high. Even now we see a spread that's at 158. What does 158 look like? Well, 158 was where the Dow was October 18, when the markets really started to head lower. Or better yet, 2008. Take a look at the spread. The spread was around 150 or spiked above 150 quickly to 200 at the mid-latter part of '07. 2001, the spread 150 was when the Dow was, chugging near the highs. Now, just because the spread's high doesn't mean the market's going to, fall apart quite yet. But again, it is something to make note of, because there is a divergence. Not all stocks are moving together. They're being driven by their own macro and microeconomic forces. Of course, interest rates affect most stocks the same way, and geopolitical events, so on and so forth. But when we start to see different sectors really break apart, like we saw earlier this year when the Dow was very strong and the Russell was very weak, this tells us that there's not really a great amount of agreement in the market, and that could be the beginning of something to change. So again, we don't want to be, always to predict, doom and gloom, that sort of thing, but it is something to be aware of. And that the more pieces of evidence we have pointing in one direction or another may give us further confidence in our investment decisions. But we're going to continue to watch this and many other indicators in the economic calendar very closely. We hope this has been helpful. We look forward to seeing you back soon.